When foreign investors talk about investing in Ukraine, the discussion often focuses on how to invest, through a company or through a joint venture or maybe through a local partner. In practice, this is only a starting point. The real issue is not simply whether you invest through a company, but how the investment is structured, how risks are allocated, and what additional legal protection is built around the investment. Proper investment structuring is not about paperwork or theory. It directly affects exposure to commercial and operational risks, vulnerability to enforcement and third-party claims, and the long-term stability of the business. So, hi. Everyone, hi. In this video, I will focus on investment structuring in Ukraine, using two of the most common and widely applied structuring models used by sophisticated investors and corporate groups. These structures are not exotic. They are practiced, tested, and regularly used in cross-border investments, including in Ukraine. So let's take a closer look at how they work. So first, the core concept is separation of asset holding and operational risks. A widely adopted strategy among sophisticated investors is the segregation of asset holding and commercial activity. Please take a look at the next schema and I'll comment it. So on the picture you may see how both companies are divided. In practice, both companies are incorporated in form of LLC, so limited liability company, but one limited liability company is asset holding entity, and this asset holding entity owns tangible and intangible assets, land, buildings, production facilities, licenses, intellectual property, etc. And this company is free from direct commercial exposure. This company holds the core value of the business and is better protected from direct claims because this company doesn't execute operation activity. So, and the other company is may also be in form of limited liability company, and this is an operating or commercial entity. This entity conducts sales, distribution, and contractual obligation, carries commercial risks, and is designed to interact with the market without risking underlying assets. This is not merely theoretical. Many cross-border structuring frameworks, especially in M&A and private equity transactions, implement this separation to ring-fence capital while allocating operational risks elsewhere. So let's go further through the picture. Down below both companies' structure, you see a key or main principle for assets protection. It is first, intercompany lease and service agreements. Assets owned by the asset company can be leased to the operating entity at arm's length. This ensures the asset company earns stable cash flow without exposure to commercial contracts that the operating entity faces. Second, transfer pricing and compliance. Pricing mechanism between members of the group must reflect market standards. Ukrainian tax authority apply transfer pricing rules and documentation requirements to both related parties and investor. Non-compliance with it poses economic risks. And the third principle is security interest and guarantees. Where relevant, security interests such as pledges and guarantees can be structured into intercompany financing. Such instruments must comply with Ukrainian property and security transaction law, but when correctly implemented, they offer enforceable protection. So, as I said, both companies, holding assets company in Ukraine and the operational company in Ukraine, can be incorporated in form usual limited liability company. And for the most investments, a limited liability company is the default vehicle due to limited liability of shareholders. As we know, liability limited to capital contribution of each shareholder. Then flexible governance mechanism under Ukrainian legislation. Compatibility with international structure and principle used by European Union and North American investors. However, LLC, limited liability company, must be designed intentionally, knowing all circumstances and goals of the investment, and not simply incorporated. So, second investment structure is asset protection through security in favor of the holding company. One of the additional investment protection mechanisms often used by group structures is the creation of security interest in favor of the foreign holding company. Let's take a look at the second picture and I will comment. So in this structure participates only the holding company, so our mother company, and the asset holding company in Ukraine. In this model, the Ukrainian asset company receives financing from the foreign holding company, usually in the form of a shareholder loan. To secure this obligation, the asset company grants a pledge or mortgage over its key assets to the holding company. These assets may include real estate, production facility, equipment, or other core business assets. The idea behind the structure is simple. The holding company becomes a secured creditor of the Ukrainian asset company. This means that the main assets of the business already secure an existing obligation within the group. What this mechanism actually achieves? This type of structuring doesn't guarantee 100% immunity from claims by other creditors or from any form of external pressure. However, it significantly complicates enforcement actions against the core assets of the business. When assets are already pledged or mortgaged, third-party creditors face an additional legal layer, enforcement becomes slower and more complex, and the economic attractiveness of targeting such assets is reduced. In practice, this often discourages aggressive claims and creates additional stability for ongoing operation. Important clarification. This structure works properly only when the financing is real and documented, the security is properly registered, and the transaction reflects normal commercial logic. Granting security to a group company as part of genuine financing arrangement is a common and accepted practice in international corporate structuring. The fact that the companies are related doesn't by itself invalidate the structure. In a real business, group financing and internal security are standard tools. To sum up, investing in Ukraine, it's not only about entering the market. It's more about how the investment is structured. Proper structuring helps separate value from risk, protect core assets, make third-party claim more difficult. The models discussed in this video are practical and widely used in international business. They do not remove risks completely, but they significantly reduce exposure. In Ukraine, as elsewhere, investment protection starts at the structuring stage and not when the problems arise. Thank you for watching. Please subscribe for more practical legal insights. Till the next video, bye-bye.